In this video, I'm going to go over the 3 stocks I bought for my portfolio this week. I own a dividend growth portfolio that I'm using to build up to one day achieve financial freedom, and in this video, I'm going to talk about the 3 additions I made to my portfolio. I buy stocks every single week on the market. I like to average into my positions on ups and downs, and overall, I am a long-term dividend growth investor that plans to hold these individual stocks for at least 10 to 20 years. So that's my plan for this financial freedom portfolio that currently sits at over $65,000, and I'm up over 6%. I own a large part of my portfolio in financials, which have been hit extremely hard by the pandemic, where I'm seeing a lot of red. But overall, my other sectors such as tech, some communication, and some consumer brands have been helping the portfolio continue to grow. Every single one of my holdings in this portfolio pays out a dividend, and that dividend is growing each and every year. So for me, I like seeing my dividends growing year over year, and the share price appreciation is just an added bonus for this portfolio. I diversify myself across a bunch of different sectors of the market, and I'm always watching for some new deals during any market declines. So in this video, we're going to talk about the 3 dividend stocks I added to my portfolio this week. As you know, everyone, I am the Gen Z investor, and every single day we talk about the stock market, go over different stocks you can buy and sell within your portfolio, and in this video, we're going to talk about the 3 new additions and 3 new buys I made over the past few days. The first stock I added to my portfolio this week was Proctor Gamble, ticker symbol PG, and it currently trades at $142 a share. They are up over 15% this year alone, and they have a market cap of $353 billion. This is a dividend king. They have a strong track record of outpacing the overall market and have consistently provided investors with growing dividends for over 60 years. They have a nice consumer brand diversified portfolio of assets that continue to have strong demand regardless of economic situation. So during good and bad times, this company sells products that people will continue to need. They sell necessities that no matter what, demand will be there. So they actually released their latest earnings last week, and they beat on both revenue and earnings per share. And this company had a great signal. They actually raised their forecast into 2021 and are expecting better than previously stated numbers. So this is good news because during 2021, a lot of companies aren't even giving guidance, or if they are, they're giving very weak guidance for the next year. But Procter Gamble announced an increase and an improvement to their guidance and their expectations moving into 2021. This dividend king has done a nice job of outpacing the overall market as well. So if we include dividends and share price growth over the past 5 years, they have a total return of 116%, outpacing the overall market, which has returned only 85% in that same 5-year span. And PG has various different product lines and a bunch of different personal good and home good needs and necessities, and they have a nice diversified brand of products that no matter what's going on in the world, people still need to buy each and every week or each and every month. So that provides them with some strong, stable earnings that no matter what, revenue will still come into the company quarter over quarter. So they are a dividend-paying company that currently yields 2.22%. They pay out around 56% of their earnings in the form of a dividend, and they've been growing that dividend at a rate of 3.13% averaged over the past 5 years and have a 64-year dividend growth streak. So this just shows that although the starting yield it may be considered average at 2.2%, they have a very strong history of growing that dividend through not only good times, but through recessions and depressions. So I believe this company will continue to pay out that dividend for a long period of time and has a 99 dividend safety score. So Procter & Gamble is a company where you buy into this stock, I'm going to hold in my portfolio, and really, without any worry over the next 5+ years, I will gladly collect the dividend and the share price appreciation that has a history of outpacing the overall market. This is a company where I can sleep good at night, knowing that I'm invested into a solid brand that's diversified into about 10 different segments of the consumer good market that isn't going anywhere anytime soon. The second stock I added more to this week was Visa, ticker symbol V, currently trading at $198 a share. They're only up 15% over the past 12 months and have a market cap of $420 billion. They are still down over 10% from their pre-pandemic high set back in the month of March. Visa is a company that I believe will continue to grow over a very long period of time. With the shift towards a more digital society, the fact that we're spending less time and less money at physical retailers and transitioning more to making all of our purchases online, I think Visa is positioned in a way to see immense growth over the next 5 to 10 years. So this company is only up 15% on the 12-month chart, when other competitors in the fintech space are posting 100 to 200% gains. And the fact that Visa has been trading flat over the past few months, I believe is a very nice opportunity to jump in right now, especially because you can buy in below where they were trading in back in the month of March before we saw the pandemic. So this is a company that I believe is well positioned to continue to grow over a long period of time. The fact that their brand is a household name and is actually being held in almost everyone's wallets across North America is very, very strong in my opinion, and I believe isn't going anywhere anytime soon. So the total return from Visa is 164%, which includes both dividends and share price growth. That outpaces the overall market, which only returned 85%. So they have a nice track record once again of beating the overall market. And if we take a look at a quick preview of their financials, they have beautiful total revenue growth year over year. 5 years ago, they had total revenue of $13.8 billion, all the way up to $22.8 billion in the past 12 months. And Visa's net income is absolutely incredible. For $22.8 billion of total revenue, they brought in $11.7 billion of net income. They have extremely high profit margins. They're very high profit margins that are up over 50% right now. And this company brings in tons of net income and tons of revenue year over year. And if we take a look at their balance sheet, they are in a great short-term and long-term financial position. They have $25 billion in total current assets compared to only $16 billion in total current liabilities. So a very strong current ratio, way above 1, and their total assets come in at over $77 billion compared to total liabilities on the balance sheet of only $42 billion. And once again, a nice overall ratio, which shows that in the short term and the long term, Visa right now will not have any issues. And total equity on the balance sheet continues to grow over the long term as well. So of course we saw Visa's share price growth. Their share price has grown by over 150% in the past 5 years, and that is the main return factor for Visa. But they also do provide a nice dividend to shareholder that is only 0.6%. They're only paying out around 24% of their earnings in the form of that dividend, but they are growing it at a very fast rate, averaging over 20% annual dividend growth over the past 5 years. So this company has done a great job. Although you're buying in at a low starting yield, the yield in the actual dividend payment is growing from a nice rate each and every year. If we take a look, they have a 99 dividend safety score, which is considered very safe, the highest score possible. Another company I like adding to my portfolio that I don't have to worry about that small dividend payment getting cut anytime soon. And of course, I just get to watch the share price grow over the long term as well. So this was the second company I added more to my existing position over this past trading week. The third stock I bought more of this week was Verizon. Ticker VZ is currently being traded below $58 a share. They have a market cap of over $239 billion and are actually down 4.8% over the past 12 months. So they are trading below their pre-pandemic high around $60 a share and are down below 58. And over the past few weeks, they've actually been on a little bit of a downtrend, which is where I added to my position. So this is a high dividend yielding stock with a current dividend yield of 4.33%. And this company actually reported their latest earnings last week, and they saw nice results. So they beat on profit, slightly missed on revenue expectations, but not by much, and actually increased their future guidance for next year. They have more positive outlook into 2021, which, similar to Proctor Gamble, I believe will show a nice increase, and actually they will actually hit that metric in the next year, which will provide investors with some nice confidence. So the increase in their future guidance really helped me kind of add to this position at this current moment in time. And I really do believe this is a nice consistent holding for my portfolio that has strong operations. And the fact that their operations are the new world we live in is subscription based. A lot of tech companies, a lot of firms are trying to switch to a subscription based model to have monthly revenue coming in from consumers. And a lot of Verizon's products and most of their revenue streams come in through the fact that you sign up for a contract and you pay a monthly fee to Verizon. So that monthly income and that monthly revenue for Verizon is very consistent and very predictable. The fact that you can predict your future cash flows is very strong and is a very nice thing to have for a company. So I believe Verizon has strong, predictable future cash flows that will continue to grow, and they bring in immense amounts of total revenue year over year. In the past 12 months, they brought in $128 billion of total revenue. These are some absurdly high numbers, $128 billion of total revenue in the past 12 months, with $18.3 billion of net income. So this is a higher yielding stock that currently pays 4.33%, but they only pay out around 52.5% of their earnings in the form of that dividend. So it just reassures me that there's enough room for the company to keep retained earnings back into the business and grow operations, and it also leaves them enough room to grow that dividend for years moving forward. And they have a 2.5% average dividend growth rate over the past 5 years, which is low, but my dividend payment is at least matching inflation each and every year, so I'm not losing money to the silent killer of inflation over the long term. And they have a nice dividend safety score considered at 87, which once again is called very safe, so don't really have to expect a dividend cut coming anytime soon, which is nice for me. Like I mentioned at the start of the video, as a dividend growth investor, I like to put my money into hard-earned money into companies that I believe will continue to grow over the long term and continue to provide me with a consistent growing dividend payment that I don't have to worry about getting cut. All three of the stocks I added to this week are considered very safe with regard to their dividend safety score, so don't have to worry about a payment getting cut anytime soon. So those were the three companies I added to this week. Thank you for watching, everyone. As you know, I am the Gen Z Investor, and I will see you in tomorrow's video.